Welcome to Lunch Money. Coming up, why property experts are warning the mortgage crunch means house prices have further to fall. We look at whether the Bank of England is likely to stick or twist with the base rate this week. And stick around if you want to know why BP's latest update has sent its share price sinking despite oil prices remaining high. I'm Simon Lambert, and I'm joined today by This Is Money's editor Lee Boyce and Interactive Investors Richard Hunter. Lee, we get a lot of house price reports. The latest one's from Zoopla. It's told us that house prices aren't falling by as much as the others, but it's warned of worse to come. Why is that?
That's right. So the Zoopla report this week saying annual house price inflation down 1.1%, which is not as much as what a lot of experts are saying out there. The talks of house price crash and all of that kind of stuff. The reason for it, simply put, is mortgage rates have become much more expensive than they were sort of 18 months ago. We've seen that in the last year. Typically, 2-year fixed rate, still above 6%. Long-term average more of 2.5% over the last decade. So lots of people are staying put, too scared to move. It's caused a bit of a kind of freeze in the housing market, and that's why we're seeing, after a couple of years of excessive growth in the property market, a bit of a slowdown.
And where in the UK is being hit hardest by this slowdown?
Well, it's interesting because the Zoopla report in recent months has said it's all been concentrated to the southern areas, but the latest report is suggesting it's becoming more contagious. So Midlands, areas in Yorkshire are now starting to get to a point where house prices are coming down. But it actually singled out quite a lot of sort of London commuter towns in this report. So Colchester was one of them, Luton, Brighton, Canterbury, all mentioned in this Zoopla report as areas where house prices are simply falling over the last year.
And do these tend to be the areas that did the best in that pandemic boom?
Well, exactly. If you think about the pandemic boom, a lot of people were racing out of London. That race for space that was kind of talked about quite a lot. That's changed quite a bit now, and lots of people aren't doing the same moves that they were doing. And as a result, a lot of these localised areas are seeing, after years of house price growth, a real slowdown. But the pandemic boom was massive. I mean, we saw 20-25% house price gains across a lot of towns across Britain. This is a kind of, it feels like a slow moving downwards at the moment.
And on mortgages, we had some Bank of England figures out yesterday. They showed a real slump in mortgage approvals. What was interesting though was it's not just home buyers, it's remortgaging as well. Isn't that a bit odd that people aren't remortgaging when mortgage rates are so high?
That's right. So the Money and Credit report that came out for Bank of England yesterday suggesting that there were 67,000 mortgage approvals last September. This year round, we're talking at 43,000. So that's a massive, massive slump, and that feeds into the house price slump that we were just talking about now. In terms of remortgaging, lots of people are staying put with their mortgage lender. That's what that data is telling us. The large majority of people are just staying put, and simply the reason for that is because people are worried that if they swap to a lender that might be offering a cheaper rate, they might not pass the affordability checks, which is what you have to go through when you take out a mortgage. So lots of people just staying put with their lender, keeping it safe, and I think a lot of people at the moment are just trying to sigh a bit of relief, hoping that base rate might stick this week.
So it's not just that people aren't remortgaging, it's they are remortgaging, they're just doing it with the same lender because they're worried about what happens if they try to move to another bank.
Exactly. I think they're worried that they won't pass those affordability checks and they're going to get red flags somehow and potentially be in all sorts of problems. So they're thinking, do you know what, for the sake of half a percentage point or whatever it is, where they might be able to get a cheaper deal, they're just staying put, sticking with the same lender. And actually quite a lot of the time when you're with a mortgage lender for a long time, you do tend to stay put because you remain relatively loyal with them. Like, unless something really drastically bad goes wrong, lots of people tend to stick around with their lender unless there is a real cheaper deal somewhere else. But the competition in the mortgage market in the last 18 months, as we know, has not been the strongest.
Presumably it is still worth shopping around though, and you should actually check whether you can go to a different lender.
Exactly, yeah. And most people would probably still pass their affordability checks as well, but I think it's this kind of notion to play it safe, sort of think, I'm going to stick around for now, ride this out and see what happens in the next few years.
And we've got a Bank of England base rate decision this week. They paused last time at 5.25%. What's the market expecting to happen now?
Yeah, the majority of analysts are saying that they expect 5.25% again this week, another pause. It was a very tight decision at the MPC last time round. There was only one vote in it, so there's that kind of murmuring. But at the moment, lots of the money markets are pricing in 5.25%.
And savers have done well. off the back of higher rates. They're still behind inflation, but they've done better than they have been.
Yeah.
We've even seen fixed rate deals above 6% over the last few months. Are they starting to fizzle out now?
Yeah, so we've had a year of absolute bumper savings rates coming out there. We've had a number of one-year fixed deals above 6%. The real big one was the NS&I 6.2%, which stuck around for 5 weeks. 225,000 savers opened that up. Something like £8 billion poured into that account. Since then, however, they pulled the plug on that account a few weeks ago, and the number of 6% deals has absolutely collapsed. We've only got 2 left. They're probably just about going to stick around to the end of this week, experts say. And then the next best rates are sort of 5.9%. And they're all quite unfamiliar names. If you want a kind of familiar high street name, you're looking more like 5.5%. A lot of these rates have been pulled, unfortunately, in recent weeks. But a lot of people would have fixed into those deals. One-year fixed deals have been vastly popular this year. So lots of people are getting that 6% or above. But yeah, as you say, it doesn't match inflation.
So again, go hunting for the best rates. Don't just stick with your bank and act fast if you want one.
Definitely don't stick with your bank. You're not getting a 1% rate, probably above 5% with your bank. It depends what you're after. Yeah, if you're after an easy access or a longer term fix, but you should always shop around, see what the best deals you can get.
Thank you, Lee. Richard, we've had updates from the big banks over the past week. Which had the best and worst results?
Well, certainly in terms of share price reaction, you'd have to say that Standard Chartered was at the bottom of the pile. Obviously, this is a UK-listed bank with a large exposure to Asia and China in particular. And China has been something of a blessing and a curse. Certainly in terms of the longer-term prospects, obviously with the growth of the middle class and the expected growth in wealth, China remains a good hunting ground for Standard. But in the immediate term, what we've seen is that the Chinese real estate commercial sector has been under some severe pressure. And the Standard Chartered have actually put some money aside for that in terms of a credit impairment. In addition, its stake in the Chinese Bohai Bank has also been under severe pressure, and a further impairment was put aside for that. If you put those two together, there's around $900 million worth of credit provisions. So that really did take the wind out of the sails for Standard. By the same token, in terms of share price reaction, HSBC probably escaped some of the flack that its competitors had seen. It remains a sprawling giant globally, also with a good exposure to Asia, but with much more control. We have seen some increase there in the impairments as well, but in the overall scheme of things, given HSBC's size, it did little to rock investors, and the share price was fairly positive in comparable terms.
And moving back to home, are banks, British banks, making more money out of higher interest rates?
Well, the answer is yes, they are. But one of the disappointments of the earnings season has been the net interest margin, namely the amount of difference, the margin between what banks pay to savers and charge investors. Now, you've just been talking, of course, about higher savings rates. And banks have had to pay those higher savings rate, which has affected the net interest margin. Indeed, one of the other things we've seen, again, as you mentioned with the national savings switch, is that after years in the savings doldrums, customers have now been looking around to find something of a higher return on their money. And although to some extent that switching out may well be within the same bank, it has nonetheless led to a downturn in customer deposits. So net interest margin has been a particularly negative feature of the reporting season so far, and for the UK banks. And for the banks as a whole, the other theme that has been slightly disappointing is, as we mentioned before, the rise in credit impairments. Now, banks are known to overcompensate for any potential bad debts that might be further down the line. Nonetheless, it does send a signal that there could be some problems around the corner in terms of the UK consumer, even though it's very containable at the moment.
And energy giant BP has reported this morning. The market isn't impressed. What's happened there?
Yeah, I mean, the main thing with BP this morning, the preferred metric in the sector is called the replacement cost profit. And in terms of the underlying profit, let's don't get me wrong, BP remains very profitable, but in terms of comparison either against last year or indeed in terms of what the market was expecting, the number was well shy of expectations. So the share price has been down somewhere between 4 and 5% after a reasonably good run of late, given the strength of the oil price. I mean, there's plenty to be said. The company has improved its operating cash flow, the amount of money it makes from normal day-to-day operations. That's allowed it to make a further reduction in its net debt figure. And at the same time, of course, it's also announced another share buyback of $1.5 billion. Certainly in terms of shareholder returns, BP remains very much committed to that dividend yield around 4.6% as well. So BP does remain committed to shareholder returns and looks likely that that's not going to change over the coming months.
And how do investors rate those BP shares?
Yes, I mean, if you look at BP and Shell being the oil majors within the FTSE 100, we've got BP in terms of the market consensus still coming in at a buy, although Shell is just edging them. It's probably the preferred play out of the two, and we'll find out more from them later in the week when they report their third quarter numbers on Thursday.
Thank you, Richard. That's it for today's Lunch Money. Join us on Thursday for the next show. Thank you for watching.